Good morning. Okay. Good morning. I'm Siang, and I'm the moderator for today's Mid-Year Investment Forum. First of all, we would like to thank all of you for joining us at this forum on a Saturday morning. It is near the middle of 2021, and the world looks completely different. Joe Biden is now US president, and the economic recovery is underway amid the specter of rising inflation. How can investors make the most out of the brave new world emerging out of the pandemic? Is it time to return to the sobriety of value investing, or keep faith in the epic rise of growth plays? Find out more in this year's Mid-Year Investment Forum. This forum is brought to you by The Edge Singapore and sponsored by TD Ameritrade Singapore. Now we would like to invite our first speaker, Chris Brankin, CEO of TD Ameritrade Singapore. Chris will be talking about the post-Trump era in the United States. He will discuss if former President Donald Trump is indeed friendlier to markets than President Biden, how much of an impact will US policies have on other markets, and which sectors are seen to benefit from Biden's policies. All yours, Chris.
Hi, good morning. Let me see if I can share these screens properly. Thanks to The Edge, and thank you for all of you joining, for spending a little bit of your time here on Saturday morning in Singapore. Nice stormy morning. So hopefully, I'm looking outside as it's storming down the East Coast here. Let me just share my screens that I will have up here. Oh, I'm having, slight technical difficulty. Sorry, 1 second, please. I had the screens.
Is everything all right, Chris?
Yeah, I'm just sorry. I for some reason I closed my presentation and I need to pull it back up. Sorry, 1 second. Hopefully this will correct it.
All right, looks good.
All right, you should be able to see it now. And now if I can figure out how to put this in presentation mode. Present. There we go. All right. Sorry. Thanks for bearing with my technical difficulties there. Look, I think it's been an interesting week, and I think this topic and this chat is, and what we're going to have this morning is very appropriate to some of the things that we've been seeing here in the markets. Before we kind of get into this, all the things that I'm actually talking about today, like for informational purposes. I'm not giving recommendations to buy or to sell. Just as it gives some ideas and thoughts to maybe help you in your investing journey. Earlier, this is me. It's always funny looking at a picture of myself. I've been in the markets for about 25 years. I've lived in Singapore for almost a decade. So September will be 10 years that I'll be in Singapore with TD Ameritrade. Was formerly Thinkorswim, and then we were TD Ameritrade Asia. Now we're currently TD Ameritrade Singapore. And then, as many of you might know, we're probably changing names again in the near future, probably back to Charles Schwab, as they purchased us a little more than a year ago. I've been a trader my whole life. I still actively trade. I'm from Chicago, and the only thing kind of where I grew up and what I did was finance. And as soon as I graduated from university, I went to the Chicago Board of Trade, and I actually traded corn. I traded corn and corn options for a number of years in the mid and late 1990s. And then I kind of moved to some of the larger banks. Most of them don't exist anymore. They've all been bought as a bond trader. And then I moved back to the Chicago Board of Options Exchange and actually ran a trading group that traded equity options for a number of years before moving to Thinkorswim in Chicago as part of a broker dealer. And then many years later, I somehow agreed to visit Singapore in January of 2009. And I, at that point, applied for a license to open a company here. And lo and behold, 10 plus years later, I'm still here and looking to make Singapore part of my permanent home. So enough about me, kind of what we're going to talk about today. So I don't have a whole lot of time, but so I could spend an hour on each one of these topics, but we're going to spend just a few minutes. And basically what I want to do, what my hope is to kind of everyone that's on here that has some type of, an idea or take something away that might help, with your investing, with your trading in terms of ideas, in terms of what type of direction you think markets might be headed, what things we've seen historically, what we see, what our customer base is not only trading across Asia, but across the United States as well. And then, kind of at the end, we'll kind of touch on like, what's next? Like, what does that mean? Like, if you believe that we're in this kind of inflationary environment, if we're heading into some type of rising interest rate environment, like, well, what does that mean? Or do you feel this is short-lived? And, what are some potential sectors that you might want to take a closer look at in terms of adding to your short-term trading or maybe even your longer-term investing strategies? So inflation, it has been the number one thing that you've heard over the last few weeks and even kind of month plus in terms of what's going on in the markets, especially across the U.S. I mean, when you have Warren Buffett who starts chiming in about inflation and Charlie Munger, like they're seeing real inflation. So what I like to look at is a few different things. Now, I prepared these slides earlier in the week. So the new CPI and PPI numbers actually came out and they still are trending in that same direction. And why is this really important is we see our investors at TD Ameritrade and traders around the globe pay really close attention to these numbers. So this is basically what, is a gauge in terms of what we see the consumers doing and what we see the producers doing. And now we've seen, as evidenced by, by more than half of the earnings calls in the S&P 500 for the Q1 earnings that is kind of wrapping up here into next week, is more than 50% of the CEOs on these calls have talked about or mentioned the word inflation. And they've talked about how their commodities or the things that they're purchasing are going higher, and the fact that they're raising their prices and people are still paying for it. So that's a really good sign in terms of confidence. So it's a nice trend that we like to look at from a overall economic health sector. Because one thing you have to understand is from the U.S. side, the U.S. GDP is mainly driven by the consumer. So 70% of the U.S. GDP is made up from consumer. So it's really important if we see a strong, healthy economy, like, okay, great. Can we support some of that inflation? So that's where I think maybe there's a varying camps in terms of like, are we really headed into this inflationary mode? Are we potentially heading into a rising interest rate environment, maybe in the latter part of this year or into next? And those are some things that might impact what you might be looking at from an investment standpoint headed into the latter part of this year and into 22. So as we kind of, I touched on briefly is the earnings, focus. So we're right at the end of the Q1 earnings. Like, so this was the beginning of the week. I put this together. It was like 88% of the companies that already reported. It's like 95% now. So with almost all the companies reporting for the Q1 earnings session, it has been apparent that the economies are doing better in the United States, especially across all 11 sectors in the S&P 500. If we wind back the clock and we look at this time last year, when markets started kind of into this rally mode that we've been over the last 12 months, it was really driven by tech. Tech was the main driver in terms of what was leading markets higher. But now, over the last 4 months, 5 months even now, it has been a wide like the breadth of the overall markets has been across all the sectors. I mean, energy was one of the laggards for a long time. And you've seen a lot of those stocks in the energy sector have really started to pick up as the world is starting, to come, hopefully put COVID-19 in its rearview mirror soon. I know it's hard for you to hear that, from me right now, especially from the announcement that we got yesterday here in Singapore, but the economies in the U.S. are getting back online. Europe is starting to come back out of, their lockdown modes that they've been in. And hopefully, I know we're all on the same page on this, that this is just a temporary thing that we're experiencing here in Singapore for, I guess we're calling this circuit breaker 2 for the short time being. But if you look at, in terms of the corporate earnings, like we'll call it the scorecard. So I put 88% of the companies are reported. And now this is really, what I like to focus on is the earnings per share surprise. 86% of the S&P 500 companies have beat on earnings per share and 76% have beat on revenue. And you'll see right at the bottom of my slide there. So if we stay at this 86%, and it didn't change that much this week from what was going on with some of the market choppiness, that will basically tie, the highest percentage of S&P 500 companies reporting earnings per share in more than a decade. So you'd have to go back to 2008 timeframe in terms of where we've seen this much kind of positive impact, and corporate earnings have been going up with it. And so people that have been long stocks over the last few months and few quarters have definitely been rewarded for that fact. So next thing I kind of want to touch on is in terms of sentiment. So we're talking about the trends and the earnings. So we have this sentiment that markets have been rallying, and the consumer has been more positive. They're more confidence in terms of what's going on and what they're seeing. So we've had this nice sentiment in the market as markets have continued to go higher month after month. Basically for the full year. Now, what you look at a little more closely is in terms of the maybe more near-term trends that we're seeing right now. So as a trader and as an investor for many years, this is something that we used to say all the time as market makers, and people use this phrase all the time: the trend is your friend. Whether it's money flow or it's earnings, if things are trending in a certain direction, whether it's up or down, these are things that you need to pay close attention to, especially if you're potentially looking to rebalance your portfolio or get into some type of new positions across different sectors. And if you just look at back a little over a month ago, when we had the earnings, estimated earnings growth rate for Q1 was a pretty, kind of robust number that was coming in at 23.8%. Then a month later, in late April, it got revised up to 40+%. And then it got revised again, the blended earnings growth rate in the S&P 500 to 55.4%. So much like, the earnings per share number that's coming in at the highest in more than a decade, if this stays at this growth rate, it'll be the highest year-over-year growth earnings rate reported by the index, basically since, the same time period. You'd have to go back to Q1 of 2010 was the last time it was this high. And at that point, it was only 34%. I say only 34%, but when it's compared to 55% earnings growth rate, you'll see this pretty substantial number. Now, some of this stuff is caused by the fact that we're coming out, across the globe in terms of the UK and Europe and the US, and now, China, and then hopefully soon back, on track here for Singapore is, we're coming out of this kind of slower type period, with all the COVID-19 restrictions across the globe for the last 12 months. So some of that is a little bit kind of inflated, in terms of where we were, but where we are right now. But you will see it. What I'm looking at is that trend has moved higher quarter after quarter for the last 3 quarters as we're looking more positive into the end of the year. So we also, I kind of touch on, so people, you will hear people, well, are we a little bit stretched in terms of valuation? Yeah, look, we're a little bit higher, but I think there's more, and the PE ratio, I think, the E, is more of a expectations, rather than earnings, I think at some point. But we're not super stretched. As you see some of the numbers here I have at the bottom of the screen, we're a little bit higher on the 5 and the 10-year kind of valuation standpoint, but we're not way out of line with these things. So if you think that there is still that potential for that growth going forward, these valuation numbers are not out of line with expectations of the markets, and nothing that I would be overly concerned about. But I'm not an analyst, but it is something that people are looking at and they ask about. But so from a valuation standpoint, I still think we're relatively fair value. So the last two things I'm going to touch on, I know I'm running towards the end of my time here, is we have this thing called the IMX. And for those of you who don't know what this is or have never heard it, it's our investor movement index. So we come out with this report every month, and we send it out in terms of what our customers are trading, not only in Asia, but also across the United States. And we actually make a little bit of comparison between some of the differences we see customers in terms of what they're net buying and net selling. And what we have seen from this report, our investor movement index, what literally just came out yesterday, or actually it came out Thursday, is our customers have remained risk on. And so they've been adding additional market exposure, and they've been doing that for every month for the last 12 months. And they've been rewarded for this. So we've seen in the beginning part, as I mentioned earlier, we saw a lot of that focus was shifted towards tech, 12 months ago, but now we see a wide breadth in terms of what this rally is. So we see people taking additional market exposure across all 11 sectors of the S&P 500 for the last month, as they have a little bit more positive outlook in terms of, we'll call it the post-COVID outlook. And a big part of that is, look, the Fed keeps, loose monetary policy until the country, recovers. What does that mean? So the United States Fed, with Jay Powell, is basically said, hey, look, we're going to continue to keep an accommodative stance and to support the economy, to keep interest rates low for a longer period of time, even as we see some of these bits of inflation kind of coming into the market. There's something that the Fed would pay close attention to, because their target rate is around 2% in terms of an annual rate. So it's something that they would pay close attention to. So some of the things that we see our clients doing is they also rotate out of certain stocks on monthly periods, and this is all part of this investor movement index. Where we see some of the key names, have been sold as they've hit some historic peaks. So we've seen some profit taking, and we've also seen, some of the things that maybe we'll call them the COVID type stocks, that where people have been moving a little bit of additional focus either into or out of those. And you'll just see that, from what this little slide is here, from a net bought perspective, what we have from an Asian perspective and what we have from the whole population. So a little bit more kind of, focused regionally, with Taiwan Semiconductor has been the biggest net buy stock for our customers for the last 6 months in Singapore. Month over month, it has been the #1 net new buy stock. NEO, Alibaba, JD.com, all net buys, for our Asian customer base. Not as big a focus for our US customer base. And then we see some profit taking, like I said, like with some of the FANG stocks, Facebook, Amazon, Adobe, Nokia. Nokia, I guess we'll call that the Reddit army stock. That didn't really catch fire like some of the other ones. And then we'll see some other comparisons. So we'll see like Planeteer and Walt Disney Company. It's something that we've seen bought across the whole population. And then another kind of net selling area, we've seen Pfizer. It's been stalwart in terms of the COVID-19 period. And that's also been, something that many of us probably already have as vaccines. And then Wells Fargo, and then also some of the other big banks in the US that have had a very, monumental run up, from Bank of America, Citibank. We have seen a little bit of net selling in terms of some of the larger US banks. So that's a nice report, and I'll have some information that we'll send out. Like if for those who want to have more about that, it goes into from a macro perspective, and it goes all the way down to a granular level in terms of some of our biggest net new buys and net new sell positions. So this is kind of the last kind of piece that I'm going to talk about. So we've talked about inflation, we've talked about kind of sentiment. And overall trends we're seeing from the corporate earnings sector. I briefly kind of went through the IMX, which is our investor movement index. So this is the number one question and it doesn't really change from year to year. People always ask me, well, should I be buying or selling? I mean, it's just, if I had the crystal ball and could tell you what you should buy and sell on a regular period, my seat would probably be a lot nicer chair, I guess, that I'd be sitting in, and it'd probably be on a beach somewhere that I owned. But look, I'm not an analyst, but what we want to just touch on briefly is what's going on in the market and how that might impact your investing decisions going forward. So this is going to be a relatively kind of simple look at that. But if we have this potential weakening U.S. dollar, because of all the government spending that's coming out of the U.S., from the continued stimulus payments, from what the U.S. side is hoping is some infrastructure spending, is that all this money that they're printing, should potentially keep the U.S. dollar or the U.S. dollar index, relatively low against world currencies. So, all right. So if you take that, and then are we headed into some type of, whether it's a short-term inflationary period or even a longer-term, we'll call it rising interest rate environment, like what does that mean in terms of where you might be potentially looking to invest your dollars? So like for me, it's kind of, there's two sides of that coin. If you believe that we're heading into an inflationary period and we might see rising interest rate environments, like that's going to impact more of these growth type stocks. So some of the growth stocks, the ones that have larger debt, some of the tech stocks, that's why you've seen some of the maybe short-term sell-off or some market choppiness that we saw this last week, because if you're concerned about inflation and potentially interest rates going higher, like the companies that borrow the most amount of money, the companies that have the most amount of debt, are the ones that are going to be impacted, the most negatively in terms of a rising interest rate environment. Now, if you're in the camp that I think many investors are in right now, if this is a short-term period, is this an opportunity for you to maybe take advantage of some of these dips that we've seen, especially in some of the big tech names? So from a historical perspective, the Fed is very sensitive in terms of inflation. The last time you saw any type of hyperinflation period in the United States was the late 70s and early 80s, where we saw interest rates, we saw mortgages almost hit 20% to borrow for a home mortgage. Just take a think of that and imagine your cost that would go up from the 2% mortgages you have right now. If it was 20%. So hyperinflation is something that that they definitely try and control against throughout the decades, and it's something that's not going to change. So for me, I'm more in that camp of like, I think some of this inflation period is a little bit short term, and that we are generally still focused on the fact that the economy has room to grow. I think we have a lot of focus in terms of coming out of this COVID-19 period, and hopefully we see this soon in our rearview mirrors. But the one thing that is apparent, that it's not quite gone yet. And we do see some potential choppiness in the markets. And here's the kind of last thing that I kind of want to touch on. So we've had this unbelievable earnings season. We've had expectations have been pushed higher and higher. So if we get a little bit of concerns, whether it's interest rates, inflation, if there's any additional lockdowns anywhere around the globe, that might lead to some near-term market volatility, an increase in volatility, which we could see some choppiness, some sell-offs on certain sectors of S&P 500. So I think really important to me is is to kind of reassess, if you're in this inflation camp, then you might want to look to move to more of the value, types of stocks, the stocks that aren't as high debt ratio. And if you're not in that camp, you think it's more short term, like this is an opportunity that, that many of our customers are taking. And we've seen over the last 12 months is any type of increase in volatility and market sell-offs, is this has been an opportunity we've seen customers add to their overall exposure on their long portfolio. And if you just look at it from a historical perspective, is the last line that I kind of have in there. As I was looking for information, I'm not really sure why they went back to 1926 instead of 1920, but from 1926 to 2020, inflation average is 2.9%. So, and whether you have it in bonds or cash, and its equities have significantly outperformed inflation or cash or bonds on a historical perspective. So they've averaged 10.3%. Now, like that doesn't guarantee that that's going to happen in the future, but you can see that to have some market exposure for the last 100 years has been way more, profitable for investors than basically trying to keep up with inflation with fixed income or bonds. So thanks for kind of listening and kind of to some of the ideas and concepts that we talk about. And there's one last thing, I'll give a little plug to our trade desk manager, Leng. So, with advanced trading tools and extensive library of educational resources, investing has never been easier. And that's so true. I mean, we removed commissions on our stocks and ETFs last August. It's something that, we try and focus on. We're trying to add additional folks here to make that, the kind of onboarding process faster, better. And something that I think that a number of you have taken advantage of, but for those of you who don't know as well, if you call or email our office, you can actually set up a one-on-one demo for yourself to go through our trading platform. They usually go 30 to 45 minutes, but you set up the time. It's usually in the evening when someone will call you and walk you through your computer in terms of the tools and things that are on there that maybe you're not fully aware of. So that's it for me. And this is kind of just a little slide with, in terms of the IMX. We will send out these slides from the Edge, to everyone that's on here today. But I want to say thank you for listening. And hopefully, maybe it kind of piqued your interest or maybe had you think of a different idea in terms of what you're looking at an investment standpoint going forward. And looking forward to talk to you on the Q&A later this morning.
Thank you, Chris. If you have any questions for Chris, please post them in the Q&A section so we can answer them during the panel discussion later. Up next, let's invite Professor Jamus Lim, Associate Professor of Economics from ESSEC Business School. Jamus will be speaking on the present global macro landscape. He will share his thoughts on whether the global economy will be able to recover to pre-COVID levels by the end of this year, what sort of risks to look out for, and if the rising specter of inflation could derail the recovery. All yours, Jamus.
Thank you, Siang. Let me just share my screen here. All righty. I think we can get started. So thanks for the invitation once again, and thanks to you guys for participating early on a Saturday morning. I suppose this is your last free day prior to our little circuit breaker too. So we appreciate you taking some time to spend it with us. Also, thanks to the organizers, Edge, as well as all the sponsors for this opportunity to share my thoughts with you. What I want to do is to take a step back and in contrast to the much more trader-based focus that Chris has adopted, I'm going to present to you a much more macro-oriented, global macro perspective. What you see, though, I think, is that there's quite a bit of corroboration in where we stand in terms of our assessment of the current situation and prospects. But of course, you'll probably identify a number of differences as well. And personally, I think that's reasonably healthy, and I think that will set us up nicely for the panel to come. Let me just start us off by providing you a summary of the global situation. And here are three takeaways, if you will. The first, ultimately, is that the global economy, as it turns out, is on the mend. But in many countries, you'll see that this recovery has remained very fragile. And by that, what I mean is that you can see an emergence of heterogeneity between the performance, both in terms of how they have performed thus far and how they are likely to evolve in the months ahead. And in particular, what we see is that the US and China appear to have really led global performance in the past few months. If you think about it, of course, this is unsurprising. China and the United States are the largest economies in the world. But I think what is different here is that the extent to which these economies will actually come and drag the rest of the world economies along is potentially limited. The US, of course, as we know, in recent times has turned inward quite a bit. And while we still expect quite a bit of spillover from US growth, as is traditionally the case, it is also the case that the US is now no longer just one of the major economies in the world. The other one is China. And China, in contrast to previously, has also stated explicitly that it is starting to look inward in terms of looking for drivers for growth, right? You may have heard of this term, the dual economy model that China has started to embrace and to really start to take this rebalancing of the economy a lot more seriously. And then finally, while it is the case that some pressures are emerging, the sense of, just like Chris, the sense of hyperinflation actually visiting us is probably still remote at the moment. But nevertheless, I'll take us through a number of slides where we'll look at the evolving inflationary situation as it turns out. So I'm going to focus in terms of the high frequency data on the standard high frequency business cycle indicators, production, employment, income, and growth. And here's production, global industrial production for a number of advanced as well as emerging economies. And what you'll see is that in terms of production, at least, the economies that are experiencing contraction has really scaled back. In fact, if you look at the most recent data, so that is for March, you'll see that no major economy has actually contracted during this time. This is, of course, unsurprising because when you measure this on a year-on-year basis, the world was largely undergoing lockdowns around about the first quarter of last year. But nevertheless, it is indicative that economies are on the mend and they are on a gradual path to recovery. Now, this, of course, is not unique. This perspective is not unique. It is something that is something that has also led to upgrades. So here are estimates by the IMF, and you can see that as of the latest IMF World Economic Outlook that was released in April, you see significant upgrades for their expectations for what 2021 is going to be, and even a modest upgrade for 2022. And if you look at market participants, in particular, these are purchasing manager indexes, which is a very good gauge, I think, of the kind of sentiment, at least from the producer side of the story. And you'll see that if you look at PMIs, both worldwide as well as in specific major economies, these are all mostly not just improving, but actually flashing green, meaning that they are in significantly bullish territory. So this forward-looking indicator, at least among market participants, is one of the very strong signs that, at least in the production side, the world economy is starting to recover. And of course, we see this also in price data. Chris shared earlier on about PPIs and how the producer price index itself has risen in recent times. And so this is unsurprising in light of the fact that producers themselves are very bullish in terms of how they're performing. Now, if you look at other indicators, though, the picture is potentially a little bit more mixed. So this is disposable income among the advanced economies. And what you'll see is that with the exception of the US, where incomes is clearly on an uptrend, the performance in the other G4 economies, so the the UK, the Euro area, as well as Japan, is actually a little bit more circumspect. So, of course, on average, they have improved over time, but you also see downturns. Part of it being an inability in some instances to significantly manage the pandemic in their economies. Now, if you turn over to EMs, you'll see that in terms of sales, there has been some successes. Notably, if you look at China, you'll see that sales in China, which is one of the major non-commodity EMs, has certainly picked up, and to some extent in Korea as well. But you also see that this story has been much poorer in certain other economies, India notably, as well as in Latin American economies. And you see this story in terms of Latin America play out likewise to some degree in Brazil and in other commodity-reliant emerging markets, such as Indonesia, which has, as of late, started to struggle quite a bit in terms of their success with managing the pandemic. Now, unsurprisingly, with the US printing such strong numbers, a good reason for this has been the willingness of the United States to really go really big with its stimulus, right? With the latest stimulus, I think one reason why there were so many revisions in terms of macroeconomic outlook has been because the US, after securing a modest majority in the US Senate, was able to roll through a stimulus package that was even larger than what would have been anticipated prior to last year's elections. As a result, what you see is not only has the print for the first quarter in the US been very solid. Remember, these are annualized numbers, so the quarter-on-quarter number is actually not as large, but nevertheless, 6% for the US in the first quarter takes it pretty much close to the pre-pandemic trend. And if you look at nowcast, so these are estimates of the emerging second quarter GDP for the United States, you'll see that across the board, averages are around something in the order of 8%, 7 to 8%. And these are very solid numbers. If the US is able to pull off the 7 or 8% come the second quarter of this year, it will be solidly on recovery, and that there's some hope, of course, that this recovery will begin to spill over as it traditionally has to the rest of the world's economies. Now, China's rebound, in contrast, is, while it has been the most impressive among emerging economies, so what you see here is industrial production growth for a number of large emerging economies. You see China clearly has ticked up and is far above that of the other emerging economies. The caveat that I have for you here today is that, as I alluded to in my introduction, we are in a process of seeing a rebalancing in China. Now, this rebalancing, of course, is not new to the extent that China has always known that it has had to rebalance its economy. It started that process way back in 2013 and 2014, and it was a significant part of the five-year plan that was released at the time. And what you see in the red line is actually the difference between the rate of growth in the services sector and the manufacturing sector. So to the extent that this is rising, this suggests a process of a greater emphasis on the services sector, a greater emphasis on kind of a inward-looking internal dynamics as a channel for growth, as opposed to the traditional Chinese model, which has relied much more on manufacturing, much more on outward orientation and exports as a driver of growth. And what you see is that process actually stalled. It stalled around about 2017. And while it was the case that there wasn't any clear retreat in terms of the contribution of the services and the tertiary sector, we didn't see a significant pickup in terms of the consumer share of the economy because of this, I would put to you, stalling in the contribution. Now, of course, unsurprisingly, as a result of the lockdown, you saw a significant collapse in the contribution of services. China went back to a tried and true method, which was to go to its industries and to try to eke out growth from that dimension. But what you'll see, at least in the most recent data, is a massive pickup, and that recovery in China in terms of how much it has relied on the tertiary sector to pick up. Now, the caveat here is to keep in mind is that because the service sector was the one that contracted more, it's unsurprising that the services sector will also be the one to grow faster. But you'll see that the rate of growth of the services sector, at least in the first quarter of 2021, has far outstripped that of even the manufacturing sector, which has been historically one of the levers that the Chinese government has leaned on in terms of picking its economy out of historical contractions. So what the upshot of this is that we, unlike in the past, where, to be fair, China hasn't always been a major demander from the rest of the world, but it has demanded from certain economies, especially from commodity exporters such as Australia, such as agricultural exporters such as Brazil, and even to some extent the Japanese economy. We might expect the Chinese economy to contribute relatively less even to its regional and global trading partners. Now, this brings us to inflation. And as Chris shared earlier on, there is an increasing sense that inflation is rising. And if you look at the panel, you'll see on the left panel that is advanced economies, and on the right panel is developing economies. During the COVID period, of course, you saw a collapse in inflation globally. So I'm showing you median inflation as well as the not the upper, but the 25th and the 75th percentiles of the bounds of inflation among the advanced and the developing economies. What you see on the left panel is that median inflation has in fact picked up. But recall, what has it picked up to? You'll notice that it's still roughly around 2%. And keep in mind that for most central banks, advanced economy central banks, the target inflation rate is actually 2%, or in the case of the European Central Bank, close to but slightly below 2%. You see that we're just returning to this target rate of inflation among developed economies. And if you look at emerging economies, you'll see that while it is true that median inflation has also picked up, traditionally inflation has been a lot more aggressive in emerging economies. The average inflation rate as well as the median inflation rate in emerging economies prior to the most recent 5-year period has usually been in the order of 5.5% to 6%. And what we see is that it's just now starting to eat past 4%. So overall, it's relatively quiescent by and large and close to targets at the moment. So that behooves us then to turn to looking at contributors to whether to kind of provide a bit of a crystal ball as to whether we think inflation may be increasing in the future. Now, the traditional way that most central bankers look at this is through the lens of what you probably know as the Phillips curve, trying to balance the inflation-unemployment trade-off. And what you see here in terms of wage inflation, though, is that there's really fairly limited pressure emanating from wages, right? You see some of this in China, but that also comes off a period of relative weakness, and if you look at the rate of growth, you'll see that it is still below what has been the case in the past decade. Now, if you look at the pressures that may come from the commodity complex, this is where you're starting to see some hints at the kind of concerns about pass-through inflation. So commodities have definitely taken off, and in particular, agricultural commodities, which you see in the green dots over in the chart. So agriculture has really picked up in terms of the contribution to overall inflation, and that's the concern, that it will pass through and eventually show up into goods prices. You hear all sorts of anecdotal evidence, most recently in terms of the prices of lumber. Now, you also see increases in industrial metals. What I'll just note here is that while it is true that it is climbing, some of the more indicative industrial metals, such as copper, remains reasonably quiescent. And likewise, as Chris also mentioned prior to me, while we do see some pickup in the energy complex, the contribution from energy inflation is significantly lower than even as recently as 5 years ago. And what about the markets? What do they think? Well, with the exception of the United States, so what you see here in the chart is expectations of inflation in the short run. So these were constructed out of inflation swaps. And what you'll notice is that break-even inflation that is being priced in by financial markets is overall just returning to where it used to be around about 2 years ago. And the one contradiction to this, if you will, is the United States, where market participants are starting to price in rates of inflation that actually even exceed the Federal Reserve's target. Now, this is not going to be entirely surprising, of course, because the Federal Reserve has already telegraphed in advance that it expects inflation to actually exceed that 2% target rate, and it is comfortable with allowing some of that overshoot. So this is just a rational pricing in by investors. The question, of course, is if it starts to become something significantly higher, something in the order of 3.5, you fear that expectations may start to become unanchored. And that's when I think it will be very difficult for the Fed to actually stand aside and not act more decisively in terms of hiking at least the policy rate. Now, if you look at the money supply, this was a concern by some quarters in markets. And it is true that because of the manner by which the stimulus package was rolled out, many economies saw a significant increase in their money supplies. But even there, you'll see, notably for the United States, that increase in the money supply has already begun to taper. And I would actually argue that if you continue to see this tapering, you won't in general see much of a pass-through. What you see would just be a one-time spike. Remember, inflation is a process and not a one-off circumstance. So even if you do see an increase in the year-over-year rate of growth of the CPI, this really only becomes a problem for an economy as well as risk assets if it were to become entrenched on a month-to-month basis. So what are some takeaways? So in the last few minutes that I have, I'll just summarize a few points about what you can take away from this global investment picture in terms of how you might want to invest if you were to adopt a kind of more global macro strategy. Now, I had shared in previous fora, as well as with other clients, that by and large, the goal here is to move toward a process of diversification. And that diversification, I believe, actually happens on several fronts. One, it's happening in terms of equity factors. Most notably, the key equity factor that has outperformed in the past year has been both the growth factor as well as large cap. Now we're seeing a reversal. That reversal started to take root sometime in the beginning of the fourth quarter of last year, where you started to see a shift toward both small and medium cap small and medium cap firms as well as value firms. So that is one dimension, a shift away from this large cap growth stocks into small, medium value stocks that I think will continue to play out, especially given the degree of equity undervaluation for valuation, for undervaluation for valuation as a mouthful. Now, from the kind of investment from a business cycle perspective, you're also starting to see a shift away from the more defensive sectors, so healthcare as well as utilities, and of course, as we all know, a shift away from high-flying tech to the kind of sectors that tend to do very well in an early cyclical recovery. Here you see financials, and financials has already gained quite a bit. You're starting to see this in energy, as I showed you earlier on, in terms of global energy prices, and that is starting to feed into investor behavior. And if you wish to be relatively early, there are some people who are taking speculative but in my view, not necessarily a bad move into the tourism sector. Of course, you will need quite a bit of patience if you want this theme to play out. And then the final area of diversification is out of the United States and into other parts of the world. Especially if you are a medium-term investor, selectively into Asian emerging markets. We have been largely agnostic about emerging market Asia for the past few years, but in recent times, it has become more and more important to be kind of selective in terms of the kind of exposure that you take on in EM Asia. And likewise, I think while it is still reasonably early to take on exposure in Europe, especially in developed Europe, the patient investor can consider taking on European, especially European bank stocks as one of the value propositions that exist out there. I also let me talk a little bit about the yield curve steepening, and I think, do I have a chart for this? I don't have a chart for this, but I did want to share a little bit about the yield curve steepening. So if you do a decomposition of the yield curve into the various components, into the term premium, into the expected inflations, and into the real interest rate, what you'll see is that while it is the case that the yield curve has steepened this year, a lot of that has been driven by increases in both the term premium as well as expected inflation. So there's no surprise there, but as it turns out, real interest rates have actually trended downward all this time. And what this means is that to the extent that real interest rates are still moving in the opposite direction to the other components of long-term yields, you might expect that there will be this restraining effect that comes in terms of the extent to which the yield curve can continue to steepen. So while we expect a steepening to persist this year, so we won't see a reversal, at the same time, we don't expect this kind of long-term bond bear where you would see a reversal of the past 30 years where there has been a long-term bond bull market. We don't kind of see a launching into that quite yet. So I'm aware that I'm a bit over time, so just wrapping up. So here are some slides that give you that corroborate a lot of the points that I just made earlier on verbally. You start to see US stocks, but also emerging market stocks performing quite well. Likewise, if you look at regional equity markets, you'll see that Asia ex-Japan has been doing very well. And of course, the Chinese stock market, of course, a lot of this is already priced in. So you want to be very careful if you're going to be taking additional exposure if you haven't already done so. If you have already exposure to these markets, I will continue to hold on to these, but I wouldn't necessarily be ramping up exposure at the moment. Now, in terms of rotation, you'll see that small cap and mid cap value stocks have significantly outperformed. And then finally, if you look at the ETF performance for the different equity sectors, you'll see the energy, financials, all these early cycle stocks have indeed done better this time around. Here was that decomposition that I promised you. And as you see from this chart, you'll see that long-term real interest rates, just in that little segment over there in the past month or two, you'll see that real interest rates have actually dipped down, which at least to us is suggestive of the fact that we won't see nominal long-term interest rates take off anytime soon. Okay, so I will stop here. Thank you for your time.
Thank you, Jamus. Do post your questions for Jamus in the Q&A section so you can answer them during the panel discussion later. We'll be going for a 5-minute break before I invite the next speaker on stage. See you in a bit. Hello, everyone. Welcome back to the Mid-Year Investment Forum. Now let's welcome Leng, Portfolio Manager of Heritage Global Capital Fund. Leng will be speaking on the future of value investing. Growth stocks were in favor at the height of the pandemic, while value stocks suffered. But with recovery taking place, there now appears to be a rotation in the other direction. Can value investing still remain relevant today? Or will growth investing be the new normal? All yours, Leng.
Hi, Siang. Thank you. Let me see how long this thing gets started. Hello. Okay. Good morning, everyone. Thank you for actually taking the time today on a Saturday morning to actually attend today's presentation. I hope everyone actually has had their breakfast ready, or probably you guys might actually be having your breakfast while watching this presentation. And that's the beauty of technology today. It has actually allowed for things to become so much more efficient. And in some ways, this was actually all spurred because of the COVID-19 pandemic last year. But I'll touch more about that in the later slides. But for today's presentation, I'll be presenting on something very different as compared to what I usually present about. People in the audience who have actually attended past DH events have heard me speak before are probably more used to me talking about, deep value investing, the capital cycle approach. But today's presentation will be very, very different. Today, I'll be talking more about the fundamental shifts we can actually see in the economy today, and I'll actually be questioning whether value investing is actually dead. So today's presentation will be on the fundamental shift and is value investing dead. So for today's presentation, I'll start off with a quick introduction. I'll review what has actually happened in 2020. I'll be talking about the economy 2021 onwards. And at the end of this, there'll be a panel discussion with the other presenters. And as I always tell people, the best way to actually learn is actually by asking questions. So do actually leave your questions till the very end. A quick introduction about myself. Like what Siang said, my name is Leng. I'm the Portfolio Manager of Heritage Global Capital Fund, a long-only value-based fund in Singapore. I'm also a blogger at Investing Nook, which is my own personal website, where I share about my experiences and my thoughts on the financial markets. And lastly, I graduated from University College of London, majoring in economics. So what has happened in 2020? Other than the obvious fact that we had and actually are still going through the COVID-19 pandemic, and just yesterday, the government actually implemented stricter measures. I know the government calls it phase 2 with heightened measures. But to me, in my opinion, is actually something in between a phase 1 or phase 2, kind of a lockdown. But can you guys think, what else has actually resulted from this pandemic? And many of you might actually realize that your lives might have actually changed quite drastically comparing pre-COVID and post-COVID, be it your daily lives or your work lives. Working from home seems more like the norm now. This is not to say that offices will be completely abolished, but management will be thinking on how to actually streamline things. What kind of jobs doesn't actually require you to actually enter the office every day. You probably can actually do it from home. Perhaps, even overseas work trips. I know we can't be traveling now because of the COVID-19 pandemic, but when things actually subside, overseas work trips might not be as prevalent anymore because we can actually be doing Zoom meetings to actually do our meetings with our overseas counterparts. Even say signing of documents have slowly transited online because we have software such as DocuSign or Adobe Sign. But on a more personal level, shopping online, be it on Taobao, Lazada, Shopee, etc., is becoming more and more common, especially for the older generations. And this is something that I witnessed for my own family members. Because of the COVID-19 lockdown, they were actually forced to go online to shop for groceries or products in general. And all that initial reluctance, of My mom likes to go down to the wet market to actually look at the groceries, see whether it's fresh or not. And to her, shopping online for groceries, she felt that, there's this initial hurdle that the groceries might not be as fresh, or, buying stuff on Taobao, Shopee, Lazada. There was the initial reluctance because they felt that the product might be of inferior quality. So once lockdown actually happened and they were all forced to go online to do their shopping, all that initial, or rather the misconceptions, they were all disproved. And, post-COVID, after the lockdown, I see my parents, my in-laws, this habit of shopping online has actually persisted. And till today, they're actually still shopping online. Hence, from a surface level, these were all the kind of things that was actually happening in 2020. However, what about the economy? What are some of the fundamental shifts that we can actually see happening in our economy today? I'm quite sure everyone actually remembers this news, as it's actually still quite recent, the closing down of Robinsons. So earlier last year, Robinsons actually announced that they will be closing down their outlet at Gem, and come October, they formally announced that they'll be exiting Singapore after 162 years by closing down their last two outlets, the flagship store at Heeren and the outlet at Raffles City. However, this trend of, it is not something new, and we have actually been seeing it happen over the last couple of years or so. So this closing down of retail malls is not because of because of the COVID-19 pandemic. Yes, it might have been accelerated by the COVID-19 pandemic, but it has actually been happening even pre-COVID. So think back, on Metro closing down their outlet at Center Point. How many of us actually still remembers John Little? Or even the bankruptcy of Toys R Us. This was all happening even before COVID. And these companies that I'm talking about are not small, medium-sized enterprises, but companies with long histories. And we are actually slowly seeing them getting phased out. And it's actually very similar to what I'm actually witnessing in other developed countries such as the US and UK. Likewise, the same can actually be said for the banks. So early 2020, during the COVID lockdown, I was actually attending the three banks' AGMs. And one thing that I was hearing in common amongst all the banks' management discussion was that they were saying that a lot of their customers actually have gone digital. And due to the fact that the customers have gone digital, the banks are actually realizing that there's not much need for physical spaces anymore. And they're actually rethinking their branch strategy. So after the COVID lockdown, DBS was one of the fastest banks I saw act on this, rethinking their branch strategy. The POSB, which is located at Takashimaya on level 4 or level 5, that is actually no longer there. Even smaller branches along Orchard Road has actually closed down, like the one outside Marriott. So as we see, retail malls are slowly dying and banks are actually rethinking their branch strategy. What does this mean to us as investors? So let's just think about it. The supply of retail space is fairly constant. Honestly speaking, it's not that it's not like Ion or Wisma or Neon City, etc. It's just going to disappear. And that's the reason why I say that the supply of retail space is going to be fairly constant. However, the demand for retail space, that is actually trending downwards. Like I said, a lot of customers have actually gone digital. Companies, retailers are realizing that they don't actually need this kind of offline presence, or they don't need so much offline presence because customers have actually gone digital. And that's the reason why the demand for retail space is actually shifting downwards. But this digitalization has been happening for a couple of years already, and it's not just because of COVID that customers have actually gone digital. It's because of COVID that digitalization of customers have just accelerated. So with supply of retail space being fairly constant and demand of retail space coming down, it's supply and demand, economics 101. It just means that the rental rates will be shifting downwards as well. And this is a fundamental shift downwards. And as valuations is just a function of ROE, ROEs will be trending downwards because rental rates is trending downwards. That just means that the new fair value, that new valuation of this kind of property landlords will be fundamentally shifted downwards as well. And that's the reason why I was very, very bearish and am still actually very bearish on, property landlords in Singapore, Hong Kong, or any other developed nation for that matter, simply because I don't actually know what that new fair value is going to be. I have actually spoken to quite a few owners of retail malls along Orchard Road, and one thing in common that they're actually saying is that that new rental rate, that new rental yield is going to be drastically different as compared to pre-COVID. Those days where, property landlords were making huge margins by just renting out the space, that is of the past already. So I'd like to share a quote by Satya Nadella, the CEO of Microsoft, which I felt accurately captures the idea that I want to be sharing here about the COVID-19 pandemic in 2020. Due to the COVID-19 pandemic, we have actually seen 2 years worth of digital transformation in just a span of 2 months. Companies have actually been adapting themselves to better position themselves for the post-COVID world. And as investors, I believe that we should actually be doing the same as well. So like businesses, our investment portfolios only have either of two options. Either they stay constant and become extinct at some point in time, or they adapt and actually survive in this new world. With this, we move on to the crux of today's topic, which is how can we be actually looking at our portfolios 2021 onwards. And I believe that having a good understanding of some of the major fundamental shifts in the economy to be very crucial in actually looking at our portfolios. Some of these fundamental shifts that I'll be sharing with you guys later, it may seem very obvious to you guys or very duh, but we actually may not have been consciously positioning our portfolios as such. So some of the fundamental shifts as such. Firstly, it will be the platform shifts. And over the last 10 years or so, there have been multiple platform shifts. The earliest one that actually comes to mind is the shift from the BlackBerry platform. 10 years ago, I had my first BlackBerry phone, the BlackBerry Bold. And back then, it was really the in thing. iPhone was not really something that prevalent yet. But having a BlackBerry phone back then was really something, to be on a BlackBerry platform. And we had this thing called the BlackBerry Messenger, which was only exclusive to us BlackBerry users, and we could be using it to communicate with one another. But we have actually shifted away from that, from the BlackBerry platform to what it is today, which is the iOS or the Android. But there have been multiple other platform shifts that have actually been happening. I think one of the more prevalent ones and have been discussed quite widely on Facebook groups and all would be the shift towards the subscription platform. So companies have been shifting their business models to the subscription model, otherwise known as the subscription economy. And the beauty of the subscription economy is the compounding nature of relationships. You first acquire a customer, you charge them for the value that you are actually providing for. If the customer is happy with the service you're providing for and agrees on the value that you're actually charging them for, they'll keep paying you and they'll actually stick around for a really long time. The subscription model idea was first started by Salesforce, and it is actually still in its infancy stages. I know it has been around for about 20 odd years, but comparing to the retail industry or any other industry for that matter, 20 years on a relative basis is actually still in its infancy stages. So as we can actually see from this graph on this slide, what you can actually see is that companies will be incurring a huge upfront cost to acquire a customer. But as long as the customer is happy with the services you're providing and agrees with the value that you are charging them for that service, they will actually constantly be paying you this subscription revenue. And as you can actually see from this example, come the 9th month, you actually make back all your initial costs of acquiring that customer. And the 10th month onwards, it's pure profits. So here are some of the examples of famous companies within the subscription economy that is actually earning recurring revenues. And some of these companies might be companies that you have actually used before, be it in your daily lives or your workplaces. I think the best example is Netflix. I'm quite sure everyone in the audience here, or majority of you guys, would actually have a Netflix account And you guys are actually paying this monthly subscription to Netflix to actually just stream your favorite shows or movies today. Or maybe at your workplace, you might be using these other services such as Twilio, Okta, Zoom, DocuSign, or Fastly. And looking at the share price increases just the last year alone, you actually see how much attention that these companies are actually getting. Netflix is up about 66%, Twilio 227%, Okta 115%, Zoom 400%, DocuSign 194%, and Fastly about 300%. So you can see there's a lot of attention on these companies, especially the last year, because companies are actually adapting to actually adapt themselves to the new post-COVID world and using these kind of services to actually survive and improve themselves. So now some of you might be wondering, is this shift just isolated to more unknown and smaller companies? That is actually not true. Even the most household name, Microsoft, have shifted to the subscription model. So this was back in 2011 when they actually had to have a strategy shift. And the reason for this shift in strategy was because Google released Google Apps, otherwise known as G Suite today. And this was actually targeted at Microsoft Cash Cow, which is their enterprise customers. And Google Siege actually worked. Companies actually started shifting over to Google in the cloud rather than to deal with, the issues of installing and managing Microsoft Office offline. In the current world, or rather in the current workplace, a cloud solution actually allows companies far more variability in their work processes. So this was when Microsoft actually had to shift their strategy. So in the past, many of you will actually remember when you first buy a Microsoft Office, it comes in a CD-ROM and you just pay one fixed price and you can use Microsoft Office in perpetuality. And the only time we decide to actually upgrade our Microsoft Office is probably when we actually buy a new computer. And that's when we decide, hey, okay, I'll pay for the new Microsoft Office version, that one fixed price, and I'll just get a new CD-ROM. However, today, Microsoft Office has actually rebranded themselves to Office 365, where you either pay a monthly or yearly subscription, and your Microsoft Office version will always be able to stay updated to the latest version. So you realize that this subscription model is not really limited to really new or obscure unknown companies, but older companies, even like Microsoft, Adobe, Gillette, is also shifting over to the subscription model as well. The second fundamental shift that we have actually seen will be the shift from web-based to app-based. So back in 2010, or even before that, we did most of our entertainment, our communications via the web. Remember Mozilla Firefox, Friendster, MySpace. Just yesterday, my friends and I were talking because of the heightened measures. We were talking about how we can actually play games with each other. And one of the games we mentioned was Viwawa. Maybe this is a game of my time, where you can play games like, card games on the web browser and all, but Viwawa has closed down already. But my point is that most of what we do today was actually once conducted via the browser, just that today we're actually conducting it via apps on our phones or on a computer. And this is actually, and the third point is, this is tying with my second point, the dominance of mobile. How mobile phones are actually becoming more and more prevalent because of how we are shifting from web-based to app-based. So imagine going out with your mobile phone today, how handicapped you actually feel. And this is even more so in China. Having been to China multiple times, if I did not actually bring my mobile phone out, I would actually be severely handicapped. And, hailing a ride, paying for food, communicating with friends, that would all not be possible at all. The fourth shift will be this concept of ownership versus experiencing. In recent years, I found that for the younger generation, they place more emphasis on experiences as compared to owning something. And this is highly correlated with the sharing or the experience economy. Why own a car when you can actually just Grab or Uber? Why stay in a hotel when you can actually be trying out new experiences in somebody's home, Airbnb home? Why climb the corporate ladder and get a corner office when you can actually be a freelancer and have the freedom of working anywhere around in the world? Why are business class seats only exclusive to business travels? The younger generation today actually wants to be experiencing this as well. And you actually notice how credit cards, the reward system is shifting from in the past just giving discounts to rewarding people with miles. And this is actually to mirror what is actually happening in the economy, the shift in the thinking for the younger generation. And the last but not least, it will be this buy now, pay later phenomenon, otherwise known as the BNPL phenomenon. And this last shift is something that I want to elaborate more about, and it's something that I find not as prevalent in Singapore yet. So what is this buy now, pay later phenomenon? It's a recent trend where consumers are buying products first, taking it home without actually having to fully pay up for it on the first day and without actually incurring any interest on it. Some of you might actually liken it to be like installment plans when you buy a car, you take on a home mortgage, or even going to, Harvey Norman buying your electronics, you can pay via installments. But the company, you actually realize that the company that I'll be sharing with you guys later, it's more like a platform where there are multiple merchants on it, and the the platform is actually offering this buy now, pay later scheme for all participating merchants on the platform. And again, if I have to take a guess, what you guys are actually thinking about when I share with you guys this buy now, pay later platform is that most of the customers on this platform will probably be of high credit risk. They probably have already maxed out their credit cards, and that's why they're actually using these alternative sources of lending to actually continue funding their purchases. But before I talk about, I share more about this buy now, pay later phenomenon, I wanted to share with you guys some statistics and share with you guys, this changing landscape in terms of the spending mindset across the generations. So as you can actually see from this slide, debit cards is actually gaining traction. The volume of Visa branded payment cards in the US between the credit cards and the debit cards, you realize that the debit cards is actually catching up with credit cards. And come 2008, debit cards was almost comparable to that of the credit cards. In terms of this slide, if you're still not convinced, you'll notice that credit cards is actually losing its appeal. On the left-hand side, the graph, you'll see the credit cards in circulation in US, and you realize that the credit cards in circulation from 2000 all the way to 2019, it grew, but it didn't grow much. It grew from 1.43 billion cards in 2000 to 1.89 billion cards in 2019. And that's just a 32% increase over a span of 20 years. That means a CAGR of a very, very low single digit CAGR, and that's not great. In terms of the right-hand chart, what you actually see is the number of credit cards per person in the US, and you realize, the number of credit cards per person, it has been trending downwards. In 2009, each person has about 3.7 credit cards, and come 2019, there's only about 2.7 credit cards per person. And this is actually something that I can relate to. Having lived in London and, and moving back to Singapore, back in London, using debit cards was more of the norm. And I felt that it was great using a debit card. I just spend within my own means, how much cash I have in a bank account, that's how much I would actually spend, plus having some savings and all. So moving back to Singapore, I actually continue on using a debit card. I never really understood why I actually have to use a credit card. And the only reason why I eventually got myself a credit card was for the air miles. And yes, I'm one of those who will read Mile Lion to find out what's the best way to gain miles, the fastest way to actually gain miles. But even though I got myself a credit card, I only got myself one credit card because I felt that, having multiple credit cards, that there was no point. And it's a huge hassle, managing so many different credit cards. So these charts and figures are something that I could actually relate to. But why is credit cards actually losing its appeal? Moving back to Singapore, not wanting to use a credit card, using a debit card, or even just using one credit card, I thought that this was something that only I'm thinking about it. I did not know that actually a lot of people out there are actually not really wanting to use credit cards anymore. And as you can actually see from this graph, it shows the average credit cards per person by generation. So as you can actually see, it peaked for the baby boomers, where they actually have 3.5 credit cards per person. Come the next generation, which is Generation X, there's only about 3.2 credit cards per person. The millennials, it only has about 2.5 credit cards per person. And come the Generation Z, there's only about 1.4 credit cards per person. And what you actually realize is that the younger generation is opting to have lesser and lesser credit cards. So a lot of survey and research has actually been put into this, and a summary of these research papers is as such. Many of the younger generation, having actually seen their parents go through the global financial crisis, is a bit more wary when it comes to using credit. They have actually seen the detrimental effects of using too much credit and being too over leveraged. And surveys have actually shown that those at the age between the ages of 18 to 29 years, only 33% of them actually owns a credit card. But one thing I do want to highlight is that this research or this statistics is actually for the US market. And that's the reason why I say that this buy now, pay later phenomenon or this shift in spending mindset is not as prevalent in Singapore yet. So having understood this shift in spending mindset of the younger generation, we go back to the initial question, whether people using these buy now, pay later platforms. And the buy now, pay later platforms, the target audience is really the younger generation. So the question is this: are these people on these buy now, pay later platforms, are they highly leveraged, and have they actually maxed out their credit cards? So the first time I actually heard of this buy now, pay later platform, taking installments to buy your clothes and all that, I heard it from my wife. She was actually sharing with me her friends in Australia that, they were buying clothes. The total purchase price is maybe about 50 to 100 Aussie dollars, and they were paying it with installments. And, when the first time she shared this with me, my initial reaction was quite shocked. I was like, are your friends really, shopaholics, that they have maxed out their credit cards, that they have no money in their bank accounts? And that's the reason why they have to take installments to even buy a simple clothing between $50 to $100. Because in Singapore, the only time we actually take installments is for huge ticket items, buying a house, buying a car. That's the only time we take installments. But buying clothes, we are not going to take an installment plan to buy clothes. But it's only upon deeper research did I actually realize that there's actually a shift in spending mindset. And it's actually, if you can actually see from this chart, we realize that the customers on these buy now, pay later platforms are not highly indebted. On average, 50% of them have a coverage of 5 times of cash in their bank accounts versus their total purchase price. 21% of them have about 2 to 5 times coverage. 7% of them have a 1 times coverage, and 21% of them cannot actually cover their purchases. And upon deeper research, you actually realize that remaining 21%, what they actually shared was that they actually paid weekly or bi-weekly, and they know that the incoming cash is actually able to match the outgoing cash flow that is actually happening. So therefore, you actually realize that initial thinking of consumers spending on buy now, pay later platforms to be not really a high credit risk, and they are not actually over levered in that sense. So the company that I want to share with you guys quickly, it's called Afterpay. Because of time constraint, I cannot go too deep into Afterpay, but I'll share with you guys how you can actually get your hands on a write-up I did on this company. And I am actually personally invested in this company as well. Afterpay is the leading #1 player in the buy now, pay later industry in Australia. And
excuse me, Leng. I just wanted to tell you that please wrap up your comments in about 2 minutes because we're running slightly short of time for the Q&A. So yeah.
Sure, no worries. So like I said, I'll quickly run through Afterpay. They have some of the biggest brands under them, like Urban Outfitters, Lululemon, ASOS, JD, etc. And they actually have become such a household name that Afterpay has actually become a verb in Australia, where people and friends would just talk about, like, why don't you just Afterpay this? The revenue model of Afterpay is as such. when you use Afterpay to make a purchase, you only pay an initial 25% down payment, and the remaining 75% is split over the next 6 weeks, and there is no interest charge whatsoever until as long as you actually meet the payment deadlines. Instead, credit cards make money when you don't pay up, but Afterpay's revenue model is not that way. They actually earn money from the merchants between 3 to 6%, depending on how big the merchants are. And if you actually miss a payment deadline, what actually happens is that the service just halts itself. You pay a late payment fee, but there's no interest charge whatsoever. And the reason is because Afterpay's revenue model is not on the customers, but more on the merchants. Like I said, Afterpay has become such a household name that people actually use it like a verb. There's a lot of customer love, as can be seen from the Net Promoter Score. Afterpay ranks quite highly of 53.6 times, and it's even higher than Apple Pay, PayPal, Google Pay, or Samsung Pay. Hence, we can actually see that it's a highly loved product. This is just another example of how much consumers actually love Afterpay, where 86% of their orders are actually from repeated customers, and they are actually constantly engaging their users on their platform, on their social media and all. There are times when consumers actually know that they're going to miss a payment, and they actually will call us Afterpay up because they love the service so much to inform Afterpay that they'll be actually missing a payment. Is there something that they could work out to actually continue using the service? So you can see this actually allows Afterpay to jump ahead of the risk curve as well. And as of 2020, the default rate of Afterpay is only 0.85%. And this has been coming down from fiscal year 2018, where the default rate was about 1.5%. Lastly, it will be valuations. If we have to look at the current valuations of Afterpay, it definitely has run up quite a bit, especially after last year. But if you look at the growth of Afterpay, it can be quite somewhat justified because Afterpay is currently replicating their model in Australia onto the US market. And the key here will be the expansion into the US market. So you look at different metrics, customer frequency, monthly underlying sales, active customers, active merchants. US is actually doing way better as compared to the Australian market. And the US e-commerce market is 10 times the size of Australia plus New Zealand. And the population in US is actually 10 times the size of Australia and New Zealand. And that's why I say that although valuations have definitely run up over the last 1 year or so, it is still justifiable given the growth rates. So before I actually end off this entire presentation, I just want to go back to the initial question I said, is value investing dead? And it's really dependent on how you define value. Value should actually shift with the times. What my grandfather would see as value might not be what I see as value in today's times. So in some sense, I don't think value investing is dead. It's just dependent on how you would actually define value investing. And lastly, like I said, if you guys want to get the write-up on Afterpay, you can just scan the QR code and I'll actually send out the write-up by the end of today. But if you guys are interested to read more of my articles, you can check out my blog at investingnote.com. But thank you.
Right, thank you very much, Leng. And do post your questions for Leng in the Q&A section so that we can answer them during the upcoming panel discussion. So right now, we're coming to the last and most exciting part of our forum, the live panel discussion. I'll be taking questions from the audience for our speakers to share their views. So without further ado, let's welcome back our panelists, Chris, Jamus, and Leng. All right, so I guess let's go straight into it and ask the first question with regards to inflation. So Jamus, Chris, you both agree that inflation is perhaps not so big a concern going forward into the year. But despite a lot of these Fed assurances especially, markets appear to be worried about a taper tantrum coming on ahead. So why are markets still concerned despite very strong assurances coming from the Fed? I suppose, Chris, you could answer first, then Jamus.
Well, look, I think you'll hear this a lot from me if you ever hear me speak, is markets like clarity. And anytime we've had this historical run up, markets are at all-time highs. There's due to be some type of volatility, maybe some profit taking. if people have some uncertainties. Now, I still am in the camp that I think some of the inflation speak is a little overblown at this point. And I believe it's not just going to be the US, but you're going to have central banks around the world are going to remain accommodative in terms of their policies and to try and keep, economies moving along, but not overheating. So I essentially, I think the picture's not as bleak as maybe some people might paint it, but that's not to say that that's not going to cause a little bit of market jitteriness here in the near term.
All right, Jamus, what are your thoughts?
Well, so Siang, I think there are markets and there are markets. So where I think you're referring to in terms of market concern often is a reflection of the equity markets and equity investors, which in general, as we know, equity markets tend to be relatively more volatile. But one of the charts I shared earlier was actually a measurement of inflation swaps. And those are markets too. These are fixed income investors. And as far as you see there is pricing for inflation that is very, very modest in most advanced economies. And to the extent that there are concerns, it is only in one segment, that's the US fixed income market. And even then, we are seeing a pricing only in the order of 2.5% to 3%. So I think when we talk about inflation, you have to really distinguish between inflation of 2.5% to 3%, certainly above the Federal Reserve target, to something that I think would have most investors concerned about hyperinflation, which is, I would argue, something in the order of 50% a year. And that's so we're simply not seeing anything in that order.
All right. Thanks very much for that, Jamus. Okay, Leng, over to you now. So you mentioned during your discussion that what people would define as value in the past when it comes to value investing is very different from what people would define value today. So in The Economist, they mentioned something about the fact that many of these new industries tend to have intangible assets rather than tangible assets creates problems for valuation based on traditional metrics. So how will you value a stock that actually has a lot more of these sort of intangible assets?
So let's say we use software as a service companies, like Twilio, Okta, DocuSign and all. It's not the best metric, definitely. But I find that it gives you a sort of a guide, that's all. I don't think the model is accurate. And by no means, I know that my valuation models are not accurate as well, but it just forms a guide. What I will actually use, most people like to use price to sales. You can use enterprise value to sales as well. But essentially, I'm asking myself, if I assume that over the next 5 years, your valuation multiple, that EV to sales, gets compressed down. Let's say, companies today are trading about 50 times, 100 times, whatever it is. It gets compressed down to something which is more sane, between 8 to 12 times EV sales. And I ask myself, can this company continue growing at what revenue growth rate? Whether is it 50%, 60%, etc. So on one hand, you're actually compressing down the valuation multiple. On the other hand, you are saying that revenue continues growing at a certain rate. And what is that ultimate CAGR, in terms of the share price, essentially? What are you actually looking at? For some of the companies that we have modeled out, especially for the software names earlier this year, and that was the reason why we were selling out the software names, was that using this valuation model, we were only looking at maybe single-digit returns or even negative returns, because the valuations were just so expensive that even after that compression and that kind of growth, you are not going to be making money. There's not enough margin of safety. So this is probably how I actually look at things. But like I said, by no means, I don't think it's accurate. But it just forms a sort of a guide for you.
Could I quickly jump in there? I think another way to look at this, admittedly, this is a much more academic perspective, is to look at valuation factors. And I think there has been a more recent shift among certain types of more quantitatively inclined investors toward looking at factors. And what's nice about this metric is that you can actually use it to identify stocks that either have a much stronger correlation than average in terms of this factor or a much lower correlation than average relative to this factor. And if that's the case, then you might reveal certain kinds of stocks that are not traditionally what you might consider high value versus low value.
All right. Thanks for sharing, Jamus. Okay, so next question perhaps is starting to look a bit more at the sort of wider macroeconomic environment. So I think, Chris, I've got a question for you here regarding some of the taxes that Biden is looking to implement of late. I think that's one of the questions that we got in our chat from the audience. So given that Biden is now looking to increase capital gains taxes, among other things, how do you see this actually affecting US financial markets going forward?
Well, look, it would have a direct impact on certain sectors more so than others. So basically, look, the companies that pay the most tax would be impacted the most. I mean, that's from a really simple standpoint. So if you look at it from whether it's technology, it's the big banks in the U.S., it's some of the big kind of service providers, the ones that, that basically make the most money would be impacted the highest. So I think it's a little bit early. I think there's going to be a lot of discussion and kind of filibustering in Congress in order to pass some of these things, because it's not just impacting in terms of, the equity prices, which I think a lot of people on this discussion might be interested in. But, I think there's further kind of impact in terms of the economies. And I don't think, any administration, especially, Biden and his administration wants to derail some of the, positive, kind of economic impact that we see right now going on in the U.S. and in other parts of the globe. But yeah, I mean, look, if you start seeing, actual legislation get passed into law, that's going to, kind of put a little damper in some of the, even these great earnings that we've had here recently out of the U.S.
All right. Thanks for that, Chris. And Jamus, over to you again. So this question I have is regards to commodities. Like you mentioned about commodities in your slides. We have some of our audience members also talking about precious metal outlook in the next 2 or 3 years. So recently, we've seen a lot of discussion about the idea that there are concerns that, not concerns, more like hopes, perhaps, that there is going to be a commodity super cycle going forward. Are you sympathetic to that sort of view?
So I think if you look purely at the movement in prices, you start to see hints of the emergence of this. But as a global macro person, I also want to see some corroborative evidence from the perspective of macro. And for me, the macro fundamentals don't quite point to the emergence of a super cycle quite yet. And here's the reason. The commodity super cycle, the previous commodity super cycles were really driven by the rise of China and its entry into global value chains. Now, that led to an extended period of time in which we saw commodity prices elevated, and then that retracted, pretty much in the aftermath of the global financial crisis. You don't see, of course, the promise that people have here is India. But you don't see India actually following the same growth model that China did. Even till today, it has experienced a little bit of a premature deindustrialization, where its economy has relied much more on services as opposed to manufacturing as an engine of growth. And if someone is to put a finger on the next manufacturing powerhouse, people are much more likely to put the finger on an economy like Vietnam. But Vietnam isn't large enough in and of itself to be driving the kind of super cycle that I think you will expect to see in global commodity prices. So at least for me, I think while I am interested in the possibility of the emergence of another super cycle, I think the jury is definitely still out on this one. And I would want to see one economy, or at least a number of economies, get together to provide the kind of fundamental support that would be the ballast for this kind of thesis.
So
right.
In terms of commodities, near term, I don't know if we're going into the super cycle, but the demand is out, stripping the supply. I mean, it just around the globe. I mean, whether it's lumber or it's, agricultural products, like that is really, I mean, Econ 101. I mean, it is supply versus demand. And at this point, it's driving everything higher, and people are willing to pay it. Is that going to continue for a longer term? I don't know, but that is something to pay attention to in terms of what you're seeing. If companies have exposure, to lumber markets or to agriculturals, it's something to pay attention to because it is absolutely impacting their bottom line.
Yeah. So for the short term, I'm in absolute agreement with Chris.
Right. So this seems to be a bit of a hot point of discussion. So Leng, I just wanted to bring you in at the moment. So how would you actually, what is your sort of outlook for commodity stocks going forward in light of the sort of prognosis that is given by Jamus and Chris earlier?
To be honest, I don't actually look at commodity stocks. It is just not something within my circle of competence, and that's the reason why I just don't look at it.
Okay, that's fair enough. But maybe here's something that could be in your circle of competence. So we've got certain questions coming from the audience about the outlook for Chinese tech stocks going forward. So given your discussion of some of the future tech trends that is going forward, maybe you could share a bit more in the context of China, which is this very dynamic market we are currently seeing at the moment.
So I guess over the last 1 week or 1 month or so, a lot of tech stocks in China or globally as well have gotten sold down quite drastically. If you ask me on China tech, I think the future is bright. I mean, no doubt that over the next 5 years or so, I do believe quite strongly that China is going to be the next superpower. The only question is when it actually becomes the next superpower. But the problem is navigating the Chinese market, which tech stocks you'll probably be wanting to be betting on. We saw that happen over the last month or so, how China is actually penalizing Alibaba, Jack Ma. So these are the kind of problems that you actually face when investing into Chinese tech companies. It's not really company specific, but more on the macro, how the government will suddenly just decide to just clamp down on Chinese tech. It's not like the US. I mean, in the US, yes, policies change and all that, but it doesn't really just target companies this way. As compared to China, they decided to penalize Alibaba, and now they are actually investigating into Meituan. In the US, you realize you have Elon Musk, he can go about tweeting whatever he wants to tweet. And everything's fine, one day they go buy Bitcoin. The other day they will just say that, suddenly Bitcoin is not very sustainable in terms of mining it. But in China, it's not that. You can't just shoot your mouth that way. If you decide to just shoot your mouth that way, your stock goes plummeting down because people expect that the Chinese government is going to come down hard on you. And that's what will happen for Jack Ma. The same happened for Meituan as well, because the founder himself decided to talk about the burning of the books during the Three Kingdoms, the Qing Shi Huang. So it's very different. I would say that you really need to know how to navigate the market, because there's a lot of different Chinese tech companies there. Even if you bet on the biggest ones does not mean that it's safe as well, as can be seen from Alibaba. And sometimes betting on the small ones, you don't actually know how robust they are because it's so competitive in China. So I would just say that you just need a bit more caution when navigating the Chinese tech scene. Yeah.
All right. Thanks for that, Leng. And maybe moving on to you, Chris, just bring you in on this topic again as well. There's been this question from the audience where they asked a bit more about the risk of Chinese companies being delisted in US markets. And you mentioned that you were willing to answer that. So I would like to perhaps hear your views on the sort of risk of this happening.
Sure. Look, I mean, similar to what Leng was just saying about, some of the Chinese tech companies. You have these Chinese listed ADRs. I sound like a broken record, but I say this all the time, like markets like clarity. And if you have these uncertainties, and whether it's what, the Chinese kind of trading commission can do against, certain sectors, or if it's, against, now we're talking, the US is imposing restrictions on certain Chinese listed ADRs. I mean, it's something that we've seen a lot of our customers and customers around the globe basically shy away from some of these particular stocks or ADRs because they don't know. I mean, there's lots of other opportunities maybe to get exposure to certain sectors or areas that don't have that risk of the Chinese ADRs getting delisted. So look, from what we see our customers doing is they are taking less exposure, whether they're buying or selling those, those ADRs, just because they don't want to one day, come in on the Monday and those stocks are delisted and it's tough to get those liquidated out of your accounts. So there is that added bit of risk, and then kind of just going back to what T. Leng was saying in terms of, I think there is absolutely, a desire for people to have some exposures to Chinese tech stocks, but there is that underlying kind of risk in terms of, what they've done to Alibaba, what they've done to some of the other tech companies is they've kind of put some of these restrictions, maybe they've driven some of the prices down. And you don't really get as much of that as a more mature US market where you have, a lot of the biggest, tech companies in the world, that you have a lot more transparency. You have a lot more, kind of a more mature trading market. You have less instances that they impact full sectors. So I mean, so for me, I mean, it's it's a caveat emptor. I guess buyer beware on the Chinese listed ADRs, because there is that underlying risk that that they might get delisted, and it might it's tough to get liquidated on some of those things, but there are some quality things that I think people are still looking to get exposure to the Chinese market, because look, it's going to be I mean, I wouldn't say next big power. It's already a big power. I mean, it's the second largest economy in the world. I mean, and it's it's going to continue to get bigger.
All right, thanks for that, Chris. And naturally, all these discussions will have certain impacts on the strength of the Chinese RMB. So, Jamus, I wanted to ask you what your outlook is for the RMB going forward.
Okay, so let me start by almost segueing from the comments from T. Leng and Chris, because I think that in a sense, one of the bigger concerns from my perspective is that of regulatory risk going forward, regulatory and policy risk. And I think that whether we're talking specifically about Chinese delisting or the risk of wealth taxes or capital gains taxes being imposed, the common area behind these is the presence of regulatory and policy risk. In fact, you could argue that once both the Chinese and the US economy get back on track, one potential contentious area would be a re-emergence of the trade war, because Biden is much more willing to work within the global system, it doesn't mean that he isn't going to take a more confrontational approach when it comes to addressing China. So with that as the backdrop and context, I think that's valuable to think about the prospects for the renminbi. And the reason is, of course, because as we know, the renminbi isn't fully convertible, which means that it's subject to all manner of regulatory risk. The People's Bank of China can easily swoop in and short circuit any degree of process in which there is going to be a correction. Now, in the medium to long run, given the prospects for Chinese growth, as well as the fact that its inflation rate is going to be relatively contained in the years ahead, you might expect some degree of strengthening, some trend strengthening. And you are seeing that in recent months with the renminbi as well. But the extent to which it is allowed to go on that path, I think, will ultimately be bound by the belief by the People's Bank of China, as well as the CCP, on the extent to which this would be ultimately be detrimental to the export prospects.
Right. Thanks, Jamus. And naturally, looking at FX again, one of the things that's perhaps like weakening the sort of other big currency out there, the US dollar, is that naturally there has been a lot of infrastructure plans being promised by Biden as part of his American Jobs Plan, American Families Plan, American Rescue Plan, all these fiscal stimulus. So, Chris, I just wanted to ask you, how do you see this sort of like infrastructure spending playing out in the US markets? And also, to what extent do you think this is like a fiscally realistic sort of like investment being made? That's one of the questions from our audience from early submissions, I think.
Fiscally realistic. That's an interesting concept. Look, infrastructure in the United States is due for upgrade. It is something that might, in my opinion, and not just my opinion, an economist, would actually drive some real inflation in the market. If you actually see some of the spending programs and things that they've discussed being actually pushed into market. So at that point is when you would look at, is the economy improving? Are they adding jobs? Is the labor department getting better? Are you having a consumer that's more confident that they can keep a job and, or maintain a job or get a new one if they're unemployed for a period of time? That's all tied together. And so if we get infrastructure spending, a labor department, and we have, a confident labor department, and we have a confident consumer, like then the Fed speak comes into play. Like, are we actually going to see some type of reason, some ammunition to give the Fed, to raise interest rates to control a spike in inflation? I mean, so that's why I think it's really important if you're looking at that as you're trying to paint a picture, going out into the latter part of this year and into 22, because realistically, you're not going to get any reason why the Fed or any central bank around the world would look to raise rates unless there's some type of real inflation that's going to cause them to, impact. Yeah, I think, Jamus said it earlier, like it's not just a one type of event that, that causes a change, to an overall kind of, whether it's inflation or the economy or any of these things, like it's a moving, system of things that impact. So I think as you look at that, I think that's really where if we start seeing these infrastructure bills getting passed, then pay closer attention in terms of what the Fed's doing. Because if you look out at the Fed, the Fed funds futures right now, they're pricing like a 0% chance that they raise rates by March of next year. So like, but that could change relatively quickly if we actually start seeing some real dollars being spent and some real inflation creeping into the markets, not only in the US, but around the globe.
All right. Thanks for that, Chris. And I guess the next question is for you both, yourself, Chris, and Leng as well. It's about a certain sort of asset that people are very interested in, the sort of ARK ETFs, which promise to actually invest in all these sort of disruptive kinds of like of sectors going forward. In light of the sort of changes perhaps that we are seeing in the economy, and perhaps how this might be increasingly integrated into US recovery as they try and build back better, for instance, how do you see the prospects for such ETFs going forward?
So are we talking specifically the ARK ETFs?
Yes, the ARK ETF specifically.
So actually, I've watched a lot of the interviews Cathie Woods have actually given. I do actually totally agree with her. I mean, that's why I talk about this entire is value investing day, talking about these fundamental shifts I actually see in the economy, which is pretty much mirrors what she's actually talking about as well. Investing into this kind of disruptive companies, simply because these are the kind of fundamental shifts that we are actually seeing. She might be way ahead of the curve. I know that she has like, she's coming up with like a space ETF, there's a genome ETF. These are totally out of my circle of competence. I can't really comment on them. But the underlying thinking behind it is the same with their fintech ETF, the innovative ETF. It's the same thing. You think about it, as human beings, we do not want to move backwards. Would we want to go back 10, 20 years ago when we were still using VCR, where, if we head out for a meeting or dinner with friends and all, and we are going to miss a show, we have to insert that VCR in, program it for a certain timing to tape the entire show. Whereas, now we have Netflix, we can just stop whenever we want to stop, watch whenever we want to watch, and immediately it goes back to the point where we actually stop. And the point I'm trying to make is we won't want to go backwards. We want to only go forward. And, the thing about technology is this. I find that people say, AI is technology, EV cars is technology. But what is technology? Just because that when we are born, the electric light is already around, cars is already around, does that mean that it's not technology? At one point, at one generation, this was also technology. Just that because we are born and we already have the luxury of these kind of stuff, we don't actually call it technology. So I do believe in investing, for all these future disruptive companies. At one point, whatever Cathie Woods is investing, maybe 50 years down the road, our future generations might be seeing all this AI to be something common and not even technology anymore. I don't know. So I do agree, with the way we are moving forward, investing in these kind of disruptive companies, because it's the right way forward.
Right. And yourself, Chris, do you have any thoughts on this topic?
Well, look, for those who don't know it, so Kathy Wood, is like kind of the innovator of this ARK ETFs and innovative kind of, look, it was very popular in 2020. I think it had 150+% return. It has definitely come off the boil, so to speak. I think it's down 35% this year. I was looking at this stuff earlier today. But look, I think T. Leng's right. I think a lot of these things are they're innovative products and things that hey, that maybe as we look to move forward. Yeah, I think some of these things are interesting ways to get exposure. I mean, that's generally, I think, when we see our customers, so ETFs are some of the biggest held products that our customers trade. And what's really nice about ETFs, it lets you get market exposure, whether it's these ARK ETFs or you want interest rate exposure, you want exposure to the emerging markets, you want exposure to China. You can do this without picking individual stocks that kind of lead you to more kind of solo market risk. If you basically all your eggs are in one basket, so to speak. So these ETFs are interesting. So if you don't know what these ARK ETFs are, something definitely worth taking a look at. Because there are some different kind of parts that you could potentially add some market exposure that. Whether it's space or geome stuff, all these different interesting things that. Look, personally, I'm not at that forefront of those things, but it is something that we see getting more notoriety, especially from the growth of 2020.
Right. Thanks for that, Chris. And I understand now it's 12 o'clock, but considering that we would like to have more time to put in more diverse opinions from the question and answers from our audience here, we would like to extend it by about perhaps 10 minutes. So I'm going on to the next question now, which will see us kind of going meta to a certain extent, because we're going to start looking at things a bit on a sort of bird's eye view, in a sense that right now we see a lot of companies and stocks in the markets. They have very good financial numbers, but their stock price do not necessarily reflect this, and vice versa. And it seems to suggest a sort of bifurcation from the real market fundamentals and the sort of emotions that are driving investors. So this question is for all of you, and I was just wondering, what are your thoughts about how investing is going to look like in the future, or in the near or perhaps foreseeable future, given this very strong bifurcation? And I think I'd like to start with this question to Jamus first.
Sorry, I had to unmute there. So I mentioned during my sharing earlier on that I think that the theme in the short to medium run is really one of a continued process of diversification. I think we touched on this briefly with Chris and T. Leng when they were talking about taking on exposure to specific, disruptive sectors. I think that that's fine. I think because ETFs fundamentally are capped on the downside, you can always think about taking on part of that small exposure to this kind of things in order to gain the upside, if you wish. But for me, I still lean back toward the notion of diversification in the medium run, and to the extent that I shared with the group that diversification leans, at least at the moment, toward geographic diversification away from the United States, as well as to some extent diversification rotate what market analysts typically refer to as rotations away from large cap growth stocks toward smaller cap value stocks. I tend to want to take on shorter term tactical exposures in that dimension rather than gun for specific investment themes that I think would play out or may not play out. So that's my broad take on investment dimensions.
Right. So next is for you, T. Leng. So my question, just to repeat as you requested, is that given nowadays that there's this very strong deviation between the actual prices of stocks and the actual fundamentals that are there, how do you see investors actually being able to make informed investment decisions given this sort of a bifurcation? Yeah, perhaps that was not so clear the previous time.
No worries, thank you. So I guess The problem I find is that with these kind of new growth stocks, essentially, you are talking about the fundamentals are great, yet the stock price, still can drop 10, 20, 30%. And I guess the problem is there's just too much expectation baked into it. And it's not that the companies are not growing. Like you said, the fundamentals are good. Recently, the US companies have been announcing their first quarter results. And a lot of these companies are reporting good results. Some of them even to the point of 100% revenue growth rates. And yet, share price is still down. Companies like Shopify, etc. And the problem I find is that people just expect too much that, even if you're growing 100%, but you're not growing 110%. Like I was talking to this other friend and we're talking about this company called Coupang. It's a South Korean e-commerce company. And it was growing about 60, 70%. And he was like, yeah, it's only 60, 70%. Which business owner would actually not want to even have a 60, 70% top line revenue growth rate? But I guess the problem is that just too much expectations that I don't actually honestly know what people are expecting. But at the end of the day, to me as an investor, it's the companies that I'm investing in, are they of good quality? Are they growing? And the stock price is more of a bonus kind of thing. Eventually, I find that the fundamentals will catch up with the stock price, or the stock price will catch up with the fundamentals. But that's the long term. But in the short term, of course, people have different expectations and all that kind of stuff. And the best analogy I always give is that, imagine if you're investing into students and you have this A-star student who has always been getting A-star. At some point, he might just get an A. And market will penalize him greatly just because he dropped from an A-star to an A. But he's still an A student, he's still great. But on the flip side, if you're investing in the failures, the students who have always been failing, the stock price will not drop much because if they fail, market already expects them to be a failure. But if they turn a failure to become a pass, market will suddenly reward them greatly. And it's just about expectations, I guess, that people are just expecting too much sometimes.
All right. That's a very interesting insight to share, Leng. And now, Chris, do you have any sort of inputs on this question?
Well, the big thing is, the earnings have been great. Earnings per share, the revenues have all been strong, better than expected on many things. And if you look at guidance going forward, and some of that guidance, or lack of guidance that some of these companies are prepared to give, is a sign that, hey, maybe they are worried about, potential tax increases, that they are worried about things that might impact their bottom line, whether it's commodity prices are going up. So, that's, that all ties together. So I don't think the way that we invest today is going to change in the way we invest tomorrow. This model is going to continue to exist. We're going to try and look at sentiment and trends and where the money's flowing. Look, it's if you could see an earnings report before the market opens, I don't know if that'll always be an advantage to you. It doesn't mean you're automatically going to know which way that stock's going to go, because a lot of it's based on, what, stocks are forward looking. So the guidance and things going forward is really important and ties into that overall picture.
All right. Thanks for that, Chris. And looking at the time now, it seems that we've got so many questions here, but time is running short. So I think I'm going to put to you the final question for today's Q&A session, and it's for all of you. And it's a sort of quick 1-minute answer to the following question. What do you see as being the main black swan events that investors should actually be looking out for going into the second half of this year? I guess let's go in the order that we started. Chris, Leng, then Jamus.
All right. Well, I guess I'll pull out my crystal ball. But I think there's these, there's even I can't remember what, some company actually comes out with their black swan potential events for every year. I think it's a little bit bonkers to, try and predict the next, global pandemic. But look, if you look at it, we're not quite out of the woods with COVID-19. We are hoping to see it in our rearview mirror. But if we see any, things that are happening in India right now, pop up in any other parts of the globe, that's the biggest thing for me that could derail this optimism that global markets are pricing in right now. But to kind of figure out what any other black swan event if anyone knows, please send me a message, because I couldn't even make a guess at that. But at the end of the day, I say this all the time, is if you don't understand what you're investing in, like, ask your broker, to learn about what you're, educate yourself in terms of not only the products you might be buying or selling, but the risk that's involved with investing, whether it's stocks or real estate or anything, just educate yourself. And I think that you'll be more successful in the long run by doing that. Thank you.
Right. And Leng, over to you. What are your thoughts?
Pretty much similar to what actually Chris said. I mean, a black swan event, there's all the unknowns, like the start of 2020. How am I going to tell you that, I do think that we'll have a COVID-19 pandemic. No one will have actually spotted it. So honestly, I mean, really like what he said, understand what you're actually investing in. And, over the last 1 year or so, I realized there's a lot of new retail investors that have jumped on board. I mean, you have all these Robinhood traders, you have Futu, you have Tiger brokers, etc. There's a lot of new retail investors, and they're just jumping on board this entire bandwagon of investing to growth companies and all that, which is fine. But really understand what you're investing in, because I remember just out with a friend at Starbucks, chatting about stocks and all, and this girl from the other table came to us and said, she heard us talking about stocks. She invested in CrowdStrike, which is a cybersecurity firm. But she doesn't actually understand why she invested in it, just that the share price is up. Everyone's talking about buying these kind of companies. The process really matters. The end destination, not so much. I mean, I know everyone cares about the end destination, but the process really matters. You need to understand why you're investing in it. And that gives you the conviction that even after, markets falling 30%, like this current market correction we are going through, at least you understand why it's down. Should you be adding more, rather than, starting to panic and like, maybe you think that the whole thing is going to reverse itself and you start selling out too early, too late, I don't know. But really understand what you're actually investing in.
All right. And Jamus, you have the last word for today. Maybe you could share some of the known unknowns you see investors potentially having to watch out for in the next half of this year.
Thank you, Siang. So for me, I like many investors looking in the markets, we are kind of cautious, if you will, about what it appears to be rich valuations, especially in US equity markets, which is why one of the themes that I emphasized earlier on was geographic diversification beyond the United States. Now, that said, I think that at least at the moment, there's sufficient breadth in market participation among other stocks, and there's sufficient fundamentals supporting the tailwind of the overall directional trend in markets, that things like sharp corrections, things like anecdotal stories about a diner in New Jersey that is valued far more than it does in sales, it will ever do in sales for the rest of its existing life. I think all these are essentially going to be anecdotal, at least at the moment. And so the way to remain secure to the possibility of black swan events is, now I'm starting to sound like a broken record, to remain diversified, and to the extent that you do want to take on specific bets, recognize that the nature of what you're doing is a bet, which doesn't rule out the possibility of taking on this kind of exposures, but at least you're conscious in your process. Don't be like the person at Starbucks that doesn't understand why they're investing in a particular stock.
All right. Thanks for that, Jamus. And with that, we have now come to the end of our webinar. So thank you, Chris, Jamus, and Leng, for sharing your fascinating insights with us today. And to our viewers, thank you for joining us, and we hope you enjoyed today's session. Should you wish to receive the presentation slides, please share your feedback on the post-webinar survey after you leave the Zoom webinar. This webinar was brought to you by The Edge Singapore and sponsored by TD Ameritrade Singapore. Do subscribe to us at theedgesingapore.com for more updates. Thank you and goodbye.
Thanks, everyone.
Cheers.